Welcome back to the deep dive. We've got a stack of documents on the table today that, at first glance, looks like a real nightmare for anyone who isn't a tax accountant.
It does. It looks very intimidating.
Okay. But if you dig into it, which is exactly what we're going to do, it's actually a goldmine of strategy.
It really is. We are looking at the examiner's report for the Advanced Taxation UK exam from late 2025. And I know examiner's report sounds so dry.
Yeah.
It sounds like a list of corrections for students who, failed a test.
That's honestly what I thought when I first opened the file. I assumed this was just for students to see, which questions they got wrong so they could pass the next time. But you're telling me this is more of a commercial survival guide.
That's the perfect way to frame it.
Yeah.
I mean, think about it. This report highlights exactly where intelligent people who have studied the law and know the textbooks completely misunderstood the commercial reality.
Right.
It's a forensic analysis of expensive mistakes. If you can understand why these candidates lost marks, you understand where real-world tax planning just falls apart.
So instead of looking at this as how to pass an exam, we're looking at it as how not to get sued by a client.
Exactly. The examiner isn't just looking for a memory test. They're looking for commercial acumen. They want to know if you can spot the trap before the client steps in it.
And looking at the pass rates, a lot of people are stepping right into that trap.
A lot of people are.
All right, so our mission is to decode this. We're going to look at 3 specific case studies from the report, Scott, Freya, and Marino Ltd. We want to find that gap between knowing the rule and applying the strategy.
Right.
But before we get into the specific clients, the report opens with some golden rules. These seem to be sort of universal errors. The first one is about command words. Is this just semantics?
It sounds like semantics, but it's actually about efficiency and, you could say, billing. The report just screams about the difference between calculate and explain.
But surely if the paper says calculate the tax, you just do the math. That seems pretty self-explanatory.
You would think so. But the report says candidates are writing essays. They're wasting 10 minutes justifying why they're doing the math, writing intros, explaining their methodology.
Right.
And the examiner is saying, look, if I ask for a number, the marks are in the spreadsheet. In the real world, if a client asks, how much tax do I owe? They don't want a 3-page letter on the philosophy of taxation.
They want a number.
They just want a number.
That makes sense.
Yeah.
But the flip side is the more dangerous part, right? When they ask for an explanation.
That's the bigger issue. If the prompt is explain with supporting calculations, and you just drop a table of numbers, you fail.
Right.
You haven't demonstrated judgment. You need to tell the client why those numbers matter. It's the difference between being a calculator and being an advisor.
Okay, so read the verb. Got it.
Yeah.
The other big general warning was about brought forward knowledge. This felt like a bit of a trap to me.
It is the biggest trap in the advanced paper. Because you're at the advanced level, you naturally assume the basic stuff, income tax bans, basic capital gains rules, is beneath you.
You think, I learned that 2 years ago, I don't need to review it.
Exactly. And they don't give you the easy marks for defining the basics.
No.
No, they test the basics heavily, but they hide them inside these really complex scenarios. The report explicitly says that knowledge from the lower level taxation syllabus is assumed.
So you can't build the penthouse if the foundation is cracking.
That's the perfect analogy. You can't.
And one last logistical thing before we get to the meat of it. Subheadings. The report seemed, obsessed with structure.
It's not about making it look pretty. It's about the analysis and evaluation marks. Those are the professional skills marks. By structuring your answer with headers like option 1 and option 2, you are demonstrating you can organize complex information.
Right. If the examiner or a client has to hunt for your point, you aren't communicating effectively.
Precisely. You failed before you've even started.
Okay, let's apply this to the first case study, Scott. This feels like a classic wealthy client scenario. Wealth, death, and a family farm.
The holy trinity of tax planning.
So lay out the scene for us.
We have Scott. He owns a farm. He wants to gift this farm to his son, Liam. And he's looking at 2 options. Option 1, sell the farm to a third party and just give Liam the cash.
Okay.
Option 2, give the farm directly to Liam.
On the surface, option 1 sounds cleaner. Sell it, get the liquid cash, hand it over. Simple.
And that's where the strategy went so wrong for so many. Option 1 was the disaster zone. Candidates got tunnel vision.
How so?
They saw a gift of cash and thought, great, that's a potentially exempt transfer, a PEAT, no immediate inheritance tax. If you survive 7 years, it's tax-free.
Which is true.
It is true regarding the gift, but Where did the cash come from?
He sold the farm.
Exactly. He triggered a massive capital gains tax event to get the cash. Candidates calculated the inheritance tax on the gift perfectly, but completely ignored the huge tax bill from the sale.
Oh, wow.
So in the real world, you've just cost your client tens of thousands in CGT because you focused on the transfer and forgot the disposal.
That's a huge oversight. You're high-fiving the client for saving inheritance tax while the capital gains tax bill is burning a hole in their pocket.
That's it. Whereas option 2, gifting the farm, directly avoids that.
It does, because of gift holdover relief. If you gift a business asset, like a farm, you can defer that capital gain until the son eventually sells it. No immediate tax sting.
Makes sense.
And since we're talking about a farm, we have to talk about agricultural property relief, APR. This is sort of the golden ticket for inheritance tax, isn't it?
It is. It can reduce the taxable value to 0, but it's conditional. And this is where the retention rule bit candidates really hard.
Retention rule, that sounds like something buried deep in the fine print.
It is. APR isn't a one-and-done relief. If Scott gives the farm to Liam and then Scott dies within 7 years, the taxman looks at that gift again. For APR to still apply at the time of Scott's death, Liam must still own the farm.
Wait, so if Liam gets the farm, decides farming isn't for him, sells it a year later, and then his dad dies?
The relief just evaporates. The gift becomes fully taxable in Scott's estate. A lot of candidates assumed that once the gift was made, the relief was locked in forever.
And they failed to warn the client. Don't sell this until your dad survives the 7 years.
That is the critical piece of advice. And if you don't tell them that, they might sell it to buy a Ferrari and then get hit with a tax bill they literally can't pay.
Okay, that's huge. Now, staying with Scott, there's a fascinating strategy mentioned about timing, delaying a gift by just 6 months. How does waiting save money?
This is a beautiful piece of technical knowledge applied to strategy. It's all about the 7-year accumulation period.
Walk us through that clock.
So inheritance tax looks back 7 years from the date of a gift to see what other gifts you've made. Those earlier gifts use up your nil rate band, your tax-free allowance, which is £325,000.
Right.
In this case, Scott had made a large gift almost 7 years ago. If he made the new gift to Liam now, that old gift would still be inside the 7-year window.
So it would be clogging up his tax-free allowance.
Exactly. The new gift would be mostly taxable. But by delaying the new gift to Liam by just 6 months,
the old gift falls off the back of the 7-year conveyor belt.
It disappears from the calculation entirely. By just waiting, the historic gift expires, the nil rate band refreshes, and the new gift gets the full tax-free allowance.
That is the definition of adding value. Don't sign that check yet. Wait 6 months.
Doing literally nothing saved thousands.
Now, there was one more snag with Scott involving a partnership. He's in a business partnership, and there was confusion about partner salaries.
This is a classic terminology trap. We use the word salary, so we immediately think employment. But in a partnership, a salary is a fiction.
A fiction? That sounds illegal.
No, it's just accounting shorthand. In the corporate world, a salary is an expense. It reduces the company's profit. In a partnership, a salary is just an appropriation of profit.
So it's a way of carving up the pie before the rest is shared out.
That's all it is. It's taxed as trading income, not employment income.
But why does that distinction matter? I mean, income is income, tax is tax.
National insurance. That's why. If you treat it as employment income, you calculate Class 1 NICs. But because it's trading income, it's actually liable to Class 2 and Class 4 NICs.
So candidates were calculating the wrong tax liability because they took the word salary literally.
Correct. And commercial acumen means knowing that Class 4 NICs are a significant cost, 9% or 2%, that you have to warn the client about. You can't just ignore it.
Let's shift gears from the personal wealth of the farm to the corporate world. The second case study was Freya. This is bread and butter for a lot of accountants. She runs a company. She wants to take money out.
The classic bonus versus dividend question.
Now, I've always heard that standard advice leans toward dividends. No national insurance, lower income tax rates. I assume that's what everyone wrote in the exam.
Most did. They've got on autopilot. They calculated Freya's personal tax liability and said, look, Freya, the dividend is cheaper for you.
And they were wrong.
They were wrong because they only looked at Freya. The question asked for the impact on the total tax payable by Freya A&D, her company.
The holistic view.
Exactly. You have to look at the whole ecosystem. A dividend is paid out of post-tax profits. It saves the company absolutely nothing in corporation tax.
But a bonus.
A bonus is an expense. It is deductible for corporation tax. And in this specific scenario, the company was paying tax at the marginal rate of 26.5%.
That's quite high.
It is. So paying a £20,000 bonus reduced the company's tax bill by over £5,000. When you netted off Freya's extra personal tax against the company's massive saving,
The bonus was the clear winner.
by a long way. It's a great example of where a rule of thumb just fails. You can't just say dividends are better. You have to run the numbers on the whole entity.
And there was a similar issue with her pension, right? Freya wanted to dump a huge lump sum into her pension scheme.
And here we hit the double limit problem.
The annual allowance is pretty generous, isn't it? I mean, £60,000 a year, plus you can carry forward unused allowances.
It is. And candidates did the math on the allowance perfectly. They said, look, she has £100,000 of allowance available. Put it all in.
But she couldn't.
No, they forgot the second limit.
Yeah.
Relevant earnings. You cannot personally contribute more to a pension than you actually earned in that tax year.
So if Freya only earns £75,000 in salary, she can't put £100,000 into her pension tax efficiently, even if her annual allowance says she can.
The taxman won't let you shelter more than you made. Exactly. It's always the lower of the two limits. Missing that is a fundamental error. You'd be advising her to put money in that wouldn't get tax relief.
Freya also had a situation with gifting shares. She wanted to gift shares in a public, quoted company. This got a bit technical.
Yeah, this is where the difference between quoted and unquoted is just vital. If you gift shares in a private company, like a family business, you can usually claim holdover relief and defer the tax.
Right.
But for a public company, if you own less than 5%, which she did, you generally cannot claim holdover relief if you gift those shares to another person.
So she pays the capital gains tax immediately on the market value.
Yes, unless she gifts them to a trust.
Why does a trust change the rules?
Because a gift to a trust is a chargeable lifetime transfer for inheritance tax. The tax code basically says if you are walking into the line of fire for inheritance tax, that immediate 20% charge, we will let you off the hook for capital gains tax and give you holdover relief.
That is such a specific loophole. Gift to son, tax bill now. Gift to a trust for the son, tax deferred.
And that's the value of a high-level advisor, knowing that one structural tweak changes the cash flow completely.
Okay, let's tackle the final case. Marino Ltd. This one sounds messy. Losses, groups, R&D.
It's the how do I pay less tax when I'm losing money section of the paper.
So Marino Ltd. has a trading loss. They also bought a new company during the year, and this purchase seemed to trigger a trap regarding associated companies.
This is a relatively new rule that people forget. Corporation tax has rate bands. If your profit is below £50,000, you pay 19%. Above £250,000, you pay 25%. But those thresholds are divided by the number of associated companies. By buying just one small subsidiary, Marino's limits were instantly halved. The lower limit became £25,000.
So a company that thought it was paying 19% suddenly finds itself in the marginal 26.5% band just because it bought another business.
Yes, and if you use the old limits in your calculation, the whole thing was wrong from the start.
Now, let's talk about the losses. They wanted to use group relief. Take the loss from one company, use it to lower the tax bill of the other. But they had only been a group for 9 months.
And most candidates knew to pro-rata the loss. They took 9/12 of the losing company's loss.
That sounds logical. You only own them for 9 months, you get 9 months of the loss.
But it's incomplete. You have to pro-rata both sides. You look at the loss of the surrendering company, so 9/12 of that. And then you look at the profit of the claimant company, 9/12 of that. The relief is restricted to the lower of those two figures.
Why is that?
It's like pouring water between buckets. You can only pour into the bucket that was actually there at the time. You can't use a loss from December to offset a profit that was made in January before the companies even met.
Ah, you have to match the time periods perfectly.
Exactly.
That makes sense when you visualize it. Now let's finish on the R&D, Research and Development Expenditure Credit, or RDEC. Marino spent money on software, subcontractors, and hardware. What actually counts?
It's a strict list. Software and consumables. Yes, 100%. Hardware, no.
Yeah.
Capital expenditure doesn't qualify for this specific credit.
And what about the subcontractors? That's usually the biggest cost for tech firms.
It is. And this is one of those specific numbers you just have to memorize. 65%. If you pay a subcontractor £10,000 to do R&D, only £6,500 counts towards the credit calculation.
Okay. And once you have that qualifying number, how does the money actually come back? Is it just a deduction from profit?
No, RDAC is weird. It's what we call above the line. It's a 3-step dance that confuses everyone.
Okay, break it down for us.
Step 1. You calculate 20% of the qualifying costs. Step 2. You treat that amount as taxable income. You actually add it to your profit.
Wait, that sounds completely counterintuitive. You're trying to get a tax break, but you're increasing your taxable profit.
I know. Stick with me. Step 3, you deduct that same amount directly from your final tax liability. So it counts as income for accounting purposes, but then acts as a cash credit against the final bill.
So if you just deduct it as an expense at the start, you've fundamentally misunderstood the entire mechanism.
Completely misunderstood it.
One final trap in Merino was the computer. The company gave an employee a computer to use and then sold it to him later.
The benefit in kind calculation. Classic stuff.
Calculating the use seems easy, just 20% of the value per year. But calculating the tax on the sale of the computer tripped people up.
It did. Logical people think. Market value minus what he paid. If the computer's worth £500 today and he pays £200, the benefit is £300.
But tax law isn't always logical, is it?
Not always. The rule is there to prevent gaming the system. You have to calculate 2 figures. 1, current market value. 2, original market value minus the benefit he's already paid tax on for using it. You get taxed on the higher of the 2.
So if the computer depreciated massively, say it's basically worthless now, you might still get taxed based on the original price.
Yes. It stops companies buying a £2,000 laptop, letting the employee use it for a month, and then selling it to them for £50. The tax man tracks the original value to make sure the full value is taxed somewhere.
That is sneaky, but I see why it exists. Wow. We've covered a lot of ground here. If you look at this report as a whole, what is the core message?
I see 4 pillars for survival in this field. 1, precise knowledge. You have to know the weird rules, like the 65% for subcontractors or that retention rule for APR.
General knowledge isn't enough anymore.
Not at all. 2, application. Don't just list rules. Apply them to Scott, to Freya, or to Merino specifically. 3, read the requirement. If it says calculate, don't write an essay.
And 4, time management. Don't calculate things that weren't asked for.
It all comes down to that.
It really emphasizes that tax isn't just about memorizing legislation. It's about solving a puzzle.
Absolutely. The report actually mentions that successful candidates tailor their knowledge intelligently.
That's a great phrase. You know, it makes me think, we live in a world of AI and automated tax software. I can plug numbers into a bot and it can calculate the tax on a dividend versus a bonus in seconds.
It can. And it will be correct mathematically.
But can it spot that Scott shouldn't sell the farm before gifting it? Can it realize that buying a small company halves your tax limits and changes your whole strategy?
And that is the provocative question, isn't it? Is the true value of a tax expert shifting? It used to be knowing the answers. Now maybe it's simply knowing which question to ask.
The software can give you the calculation, but only if you know there's a trap to avoid in the first place.
That's it. That's the value.
That's something to chew on. Next time you're looking at a tax problem, don't just ask what's the rule, ask what's the commercial reality. Thanks for listening to The Deep Dive. We'll catch you next time.